Today, I want to talk about whether or not the market hit a bottom last week, and I think we have some very interesting charts to look at that could tell us this is a very tradable low, even if it doesn't end up being a bottom, and even if we are going into a bear market. So we'll jump around and look at a lot of charts today, but the focus of this video will be assessing the odds that the market is about to see a very strong bounce from where we closed last week. So the first chart I want to look at is a weekly chart of the NASDAQ 100 triple Qs, and on here you can see we're at a very important trend line, which goes all the way back to the 2022 bear market low. We hit that level again in October of 2023 in a very nasty correction, and then we hit that level again in August of 2024, which was a capitulation event and also a correction in the NASDAQ 100. And as you can see, we are sitting at that level right now here in March of 2025, and we are also sitting at the previous high going back to August of 2024. So this is what I like to call a confluence of support, where you're getting the previous high back here from August, and you are getting the trend line support, which is going all the way back to the 2022 bear market low. And this is a level of interest. I always tell people there is nothing magical about any line you draw on a chart. Any line that we draw on a chart has some sort of bias from our personal perspective. Anybody can draw a chart on here and make it look like a bear market, and anybody can draw a line on here and make it look like a bull market. What I'm going to talk about is objective evidence, and that is where we are going to draw our conclusions from. So this is just one data point within everything we're going to look at today, and what it is telling you is that there is the possibility this is just a trend line of support, and we are just getting a retest of a breakout before we continue a bull trend, which would then send prices higher from this support. And that does mean we would have a bull market going all the way out into the summer, which would take us out into June, July, or even August. Now, this doesn't guarantee anything. It is simply saying if you wanted to take a shot in the dark and assume this was a market bottom, this would give you a very clear risk level right here at triple Q's levels of 480. So if you remember, I'm teaching risk and reward and probabilities, and we know clearly looking at this weekly chart, this is higher lows and higher highs. And the reason we know that is because right now we have 3 weeks of red coming from a previous all-time high, and that is not a lower high. So there is no way anybody can sit here and tell you this is already a bear market. What you are going to need to see if it's a bear market now will be some kind of bounce to a lower high and then a lower low breakdown, and then and only then will I start to agree people can start talking about bear markets. Now, if this didn't bounce to a higher high and we didn't make a brand new all-time high in February, this would look extremely bearish, because then it would look like a lower high rejection to a lower low breakdown. And again, this is a weekly chart, so that would look extremely bearish, but that never happened. So you can rest assured, even with this big sell-off, we are going to need a lower high bounce at some point, which is why I'm telling you this could be a very tradable low, even if it is not a bull market bottom. And even if we are going into a bear market, you are still going to get this bounce to a lower high before the flush. Now, yes, that could be a little bit subjective, because nothing says we can't continue to crash down more before we get the lower high bounce, but I just gave you objective evidence that there's two supports here right here at 480 that give us very clear levels to manage risk from. So what I'm suggesting is, because we know we're in a bull market, and if we're going into a bear market we need objective evidence, this is actually setting us up a very positive risk reward trade, where we could have bought here right around 480 for a bull market high in the 550s, and you can easily dial in your risk here to be a very favorable risk reward ratio, which would give you plenty of room to the downside to manage risk, because we have plenty of room to the upside for the reward. Now, if you don't think there's that much reward, then obviously you would dial this down to some sort of lower high bounce, and you can still get at least a 1.5 risk reward ratio, which is still extremely favorable, even if you're only shooting for a lower high bounce within this range. So yes, I do think this is a tradable low. I think it's extremely easy to manage risk here at 480. And once we get the bounce, all we need to do is see whether or not we get this lower high rejection and start a bear market or a very nasty correction, or if we're just going to continue higher and get that summer bull rally that I think is highly likely. So we don't know where we're going to bounce to. We are obviously going to have to watch price. And as I always say, let the price do all the talking. But what I can tell you is we're getting very close to knowing if we are going into a bear market. And there is no way in hell that anybody should be calling for a bear market already. Anybody calling for a bear market now was calling for a bear market when we hit this top and pull back. They were calling for a bear market when we hit this top and pull back. They were calling for a bear market when we hit this top and pull back, and they were even calling for a bear market off of the 2022 lows when we hit this top and started to pull back. So you really need to be careful listening to bears, because they will always tell you this top and pullback, by the way, was another one. every single time the market pulls back and starts to do any sort of mild pullback or even a modest correction, which is completely healthy in bull markets, you will never have the balls to buy the dip and to get a risk reward setup for a long position if you think the market's going to crash, and if you constantly have in the back of your head that every pullback is going to lead to a bear market. If you don't believe me, just look at your trading account and go look at every single one of these pullbacks and see if you came back from those at an all-time high once the market hit a new all-time high, or if your trading account was just squandering around or even trending lower because you were trying to short a bull market. So you need to assess your own odds of trading and your own ability to make money in this market. But I'm telling you, if you let emotions creep into your trading and you ignore something as objective as the triple Qs hitting an extremely important support zone on a weekly chart right here at 480, and you know we are in a bull market, which means this is increasing probability this is a higher low, which is evident by the fact that we just made a higher high, brand new all-time high before this pullback. That would mean we are in no different situation than this pullback right here where we made an all-time high. And as you can see, while we were pulling back, there was no lower high, which told us we were going to see anything more than just a pullback. Once we started to bounce to the lower high, we could have had a rejection here that sent us into a bear market, but all we got instead was a higher low from that lower high. And then we continued to break out and make a higher high and confirm we were still indeed in the bull market. So if you follow me, you understand that everything I teach you to do is follow price action, and there is nothing on the price action of this chart that tells us we are going into a bear market. So I will continue to caution you against listening to bears that are calling for bear markets, because they have no clue and they have no way to know that. They are guessing, and eventually if you call for a bear market 50 times, you are eventually going to be correct, and that one time you're correct, you are going to trick people into thinking you're smart and you know what you're talking about, but you called 50 of the last one bear markets, which means you really aren't doing very well in trading. And if anything, you're guiding people down the wrong path, constantly trying to scare the hell out of them, telling them the market's going to crash, knowing damn well you have no clue. So do not listen to perma bears calling for bear markets. I will be the first to tell you with objective evidence, if we get a lower high rejection and a lower low breakdown, that a bear market is a real possibility. But I'm not going to jump the gun. I'm not going to try to spread fear-mongering crap about how we're already in a bear market. There is no evidence from the chart, which is exactly what I want to now go look at. And to do this, we need to look at many charts, so we're going to move very quickly. And the first one is TLT, which is the 20-year treasury bond. And if you are going into a bear market that is driven by a recession and a growth scare, which is the narrative right now, that tariffs are going to send us into a growth scare and we're going into a recession, and that is going to slow down the economy and blah, 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 blah. You can go on and on and on. That would mean this 20-year treasury bond would be skyrocketing right now, and the last thing we saw it do was reject below a negative 200 sloping daily moving average. To me, that is not a recession. That is not a growth scare. Those are all narratives trying to describe price action, because for some reason, every time the market pulls back, somebody needs an excuse on why it's time to pull back, instead of just the obvious, hey, we went too high and people are just locking profits and we're letting the bears get a crumb or two here along the way. You're not seeing anything in the bond market right now that is telling you we are definitely going into a growth scare or a slowdown. You will see TLT breaking back above the 200 daily moving average, which means it needs to get back above 93. And right now we're just getting a retest of the breakout at 90. And for all we know, this was a lower high below a 200 daily moving average, and the bond market is about to be the one crashing while the stock market goes on a face-ripping bull rally. So do not buy into the narratives. Learn how to read these charts and understand what they're telling you. And if we look at SPY, which to me is the most important indication of everything that is going to happen in the stock market, because this represents the entire broad market. I talked about the idea of bouncing off of a rising 200 daily moving average and hitting a market bottom low last week. And if you look at Friday, we had a very high volume green day while we were trying to get a breakdown below the 200 daily moving average. And we had a very strong bounce into the close to close near the high of the day, which is also a bullish engulfing candle from the low and the high of the previous day, where we were also testing the 200 daily moving average. So when you look at this looks like the buyers showed up. They defended a rising 200 daily moving average, and any market with price over a rising 200 daily moving average by definition is a bull market. You cannot get a positively sloping 200 daily moving average and price above it if you are not in a market that is trending higher, and that is simply just objective facts. So right now, while SPY is above a rising 200 daily moving average, I would assume this is a bottom about to go on at least a lower high bounce. And again, if we get the lower high rejection and the lower low breakdown, I will be completely on board with the bear market thesis and I will completely support it. But that has not happened, and I don't see any reason to try to predict it, because it is the lowest probability chance in a bull market that you're going to just randomly go into a bear market without some sort of reasoning. And all of the reasoning that people are using as narratives to justify it don't make any sense, because the bond market market doesn't agree with it. And the bond market is the smartest money that you're going to find. You don't see dumb money trading the bond market. So if the bond market's not freaking out, I sure as hell am not freaking out. And the 200 daily moving average on SPY is a very clear level to manage risk from, meaning you could simply just get risk off if we start closing down below it. But you have to wait until we start closing down below it, because you could miss a very face-ripping bull rally off of that support if you're just shorting or you're too scared to buy long positions because you're believing some talking head narrative. Follow what the chart is saying. There's nothing on the chart that can lie to you, because all we do is follow price, and price is either going higher or lower. There's nothing in there that can lie to you. The next chart I want to look at is SOX, which is SOXX, and this is a semiconductors ETF. And there's a very common saying that the semiconductors lead the way, and I do believe that, especially with the AI growth and the narrative around that on how it's going to grow the stock market. And you could see the semiconductors were very weak going from their all-time high back here in July. They had a full bear market of over 27% drawdown, so they've already had a bear market. They were trying to bounce out of it, getting lower highs, double tops, and breaking down. We broke down below 210 and hit the bottom of the range at 198. So from all-time high to where we are today on Friday's close, we are still in a bear market, down 23%. So there is nothing in here that says we need to go a lot lower. We've already gone down. We've already had full-blown corrections in the semiconductors. And if you look at Friday's close, we had a bullish engulfing candle off of this range bottom low at 198. And I talked about the potential of this being a double bottom breakout if we can get here above 110 and start to push higher. This is going to be the ETF that leads the way higher in the next bull market if we are indeed going into another bull market for the summer. So watch the SOX ETF above 210. It is looking extremely bullish, especially if it doesn't break down below 198. 100% objective around following price at 198 and 210, and it doesn't get any simpler than that. And then the last chart I want to look at right here is XLF, and this is the ETF that represents the financial sector. And I talked about how important it was for the financial sector to be strong if we are indeed going to stay in a bull market. And it is telling us the same thing that we saw on the weekly chart of the NASDAQ 100 when we were looking at the QQQ's ETF, is that we are sitting at a trend line support of a bull market of higher lows and higher highs. The last thing that XLF did was make a brand new all-time high on March 3rd, and there is no way in hell you are telling me that a brand new all-time high is bearish. We are only getting a pullback to the support trend line, and we have no lower high, lower low breakdown, so there's no way you can start predicting that this is going lower in any meaningful way. You are going to need some sort of lower high rejection, which is going to mean we don't break back above 50.7, and then we start getting the lower low breakdown. And yes, if this happens, this is extremely bearish, and that would give you objective reasoning to be bearish, but it hasn't happened, and I'm sure as hell not going to predict it's happening when it's the lowest probability chance. So right here on XLF, watch this support, because you could see a hammer candle here on Friday as it tried to break the support, which means the buyers showed up. And if it starts to rally to a brand new all-time high from here, that is going to be an extremely good indication that the market is still healthy and the market is still trying to go higher within a bull market. So you have objective evidence from the bond market, the financial market, the NASDAQ 100 weekly chart, as well as the S&P 500 itself still holding up above a rising 200 daily moving average, that this is only a pullback within a bull market. And if it is going to turn into a nasty bear market, we need more objective evidence, because we just don't have it yet. If you think we're in a bear market and you want to assume we're in a bear market, that is completely up to you, but I do not trade that way. I only trade objective price action evidence, and right now the objective price action evidence tells us this is still a pullback, and if it's going to be a bear market, we're going to need a lower high rejection and breakdown, and that will be the only thing that confirms this market has officially rolled over and ready to die. If you assume the market has already rolled over and ready to die and you're trying to short the whole, and you are not going to participate in any bull rallies, you are going to leave a lot of potential gains on the sides, or even a lot of massive losses if what I'm telling you is correct, and we go from this being a pullback into another very violent bull rally that could take us all the way into late summer. So weigh the risk reward. It's okay to be prepared for both scenarios. I am 100% prepared for the bear scenario if it occurs, but I'm telling you right now, everything on these charts objectively say it is the lowest probability chance, which means if it is your highest probability chance and your preferred trade, you are likely going to have a very bad time from here. So take it or leave it. That is what I see on the charts, and I'm going to tell it like I see it. I couldn't care less if we go into a bear market. I will do very well and I'll be prepared for it, but I will need to see objective evidence from the chart, and I'm not buying into any of these narratives that I see going around, because none of them make sense. I think it's all fear-mongering crap, and that's how we got to the bear sentiment that we're at, which is another indication that we're likely hitting a bottom, because everybody is more bearish than they were in September of 2022, which was a bear market low on SPY of down over 20%. When everybody's bearish, I like to do the opposite, especially when the charts agree with me. If you want to come trade with me, the best way to do that is TSC Trade Alerts, where you get all of the buy and sell alerts for the exact percent allocations that I am taking for the TQQQ and the SQQQ. You can find out how to join by clicking on the link in the description of this video. So thank you for watching, everybody. Now go crush this market.